What if I told you that this week alone, we witnessed currency shifts not seen since 2021, central banks making moves that could reshape global finance, and economic forecasts being slashed in ways that could affect your investments, your job, and your future? Welcome back to Global Finance Weekly, here in InfoExpress. And if you want to understand what's really happening in the world economy beyond the headlines, you're in exactly the right place. This week has been absolutely wild for international finance, and by the end of this video, you'll know exactly what it means for you. But here's what makes this week particularly extraordinary. We're not just seeing isolated economic events, we're witnessing the convergence of multiple crisis points that haven't aligned like this in over a generation. The dollar collapse, central bank chaos, trade war escalation, and growth forecasts being obliterated, these are all happening simultaneously, creating what economists are calling a perfect storm scenario. So grab your coffee, settle in, because we're about to dissect one of the most consequential weeks in modern economic history. Let's start with the bombshell that's sending shockwaves through global markets. The US dollar is in freefall. The euro has just hit its highest level against the dollar since 2021. But to understand why this is so significant, we need to zoom out and look at the bigger picture. For the past 3 years, the dollar has been the ultimate safe haven. During the pandemic, during the Ukraine crisis, during every global uncertainty, investors flocked to dollars like moths to a flame. The dollar index peaked at levels not seen in 2 decades. Countries around the world were struggling under the weight of dollar-denominated debt. Emerging markets were getting crushed. Turkey, Argentina, parts of Africa, all suffering because their currencies were worthless against an ultra-strong dollar. Their governments borrowed in dollars during the good times, and when the dollar strengthened, those debts became impossible to service. But now, everything's flipping. This isn't just a normal currency fluctuation. This is a fundamental shift in global financial flows. When the world's reserve currency weakens this dramatically, it's like changing the rules of the game while everyone's still playing. European exports become more expensive, making BMW and luxury goods harder to sell globally. American goods get cheaper abroad, which sounds good until you realize it often signals underlying economic weakness. And those emerging markets that were drowning in dollar debt, they're suddenly getting a lifeline they desperately needed. But here's the part that should worry everyone. This dollar weakness is happening despite the US maintaining relatively high interest rates. That's not supposed to happen. It suggests something deeper is going wrong with confidence in American economic policy. Now, while the dollar is collapsing, central banks around the world are playing completely different games, and it's creating chaos in global financial markets. Let's start with the shocker of the week. Japan just raised interest rates to 0.5%, their highest since the 2008 financial crisis. For those who don't follow Japanese monetary policy closely, this is absolutely massive. Japan has been the global experiment in ultra-low rates for over 2 decades. They've had negative interest rates, they've printed money like it was going out of style, and they've basically been the poster child for accommodative monetary policy. But now they're hiking while everyone else is cutting or pausing. Why? Because the yen was getting so weak it was threatening to import devastating inflation. Japanese consumers were getting crushed by rising prices for everything from energy to food. The Bank of Japan finally said enough is enough. Meanwhile, the Federal Reserve dropped a regulatory bombshell Wednesday that most people completely missed. They're proposing to overhaul how much capital big banks must hold against low-risk assets. This might sound like boring regulatory stuff, but it's actually huge. They're essentially admitting that US Treasury markets are broken. Here's what's really happening. The Fed is worried that when the next crisis hits, there won't be enough buyers for US government debt. The Treasury market, which is supposed to be the most liquid, safest market in the world, is showing signs of stress. They're trying to incentivize banks to participate more, but it's like putting a Band-Aid on a bullet wound. The European Central Bank is stuck between a rock and a hard place. They want to cut rates to support growth, but they can't cut too aggressively, because it would send the euro even higher against the dollar, making European exports even less competitive. What we're seeing is unprecedented divergence. It's like watching a synchronized swimming team suddenly decide to perform different routines mid-performance. The coordination that held the global financial system together for decades is breaking down. Now, here's where things get really concerning, and this is the story that's being buried under all the market noise. Global growth forecasts aren't just being revised down, they're being massacred. We're talking about growth expectations dropping to 2.3% in 2025, which represents a massive downgrade from earlier projections. But here's what the headline numbers don't tell you. This isn't just about slower growth, it's about a fundamental breakdown in the global economic system that's been operating since the end of World War II. Global trade volumes are contracting at rates we haven't seen outside of major recessions. Container shipping rates are volatile, supply chains are being permanently restructured, and countries are actively decoupling from each other economically. And the culprit? Trade wars are back with a vengeance, but this time it's different. Effective tariff rates are climbing to levels we haven't seen in a century. Yes, you heard that right, a century. We're talking about going back to pre-Great Depression levels of trade protectionism. The last time we saw tariffs at these levels was the Smoot-Hawley Tariff Act of 1930, which many economists blame for turning a recession into the Great Depression. Now, I'm not saying we're headed for another Great Depression, but the parallels are uncomfortable. But this isn't just about tariffs on steel and soybeans anymore. This is about technological decoupling, strategic competition, and the weaponization of economic interdependence. China and the US aren't just imposing tariffs. They're actively trying to build separate, parallel economic systems. The semiconductor industry is being split down the middle. Rare earth elements are becoming geopolitical weapons. Even something as mundane as TikTok becomes a national security issue. This is economic warfare disguised as trade policy. What makes this week particularly significant and honestly kind of terrifying for anyone who understands how global finance works is how all these factors are colliding simultaneously. In systems theory, there's a concept called cascading failure. It's basically when the failure of one part of a system triggers the failure of the next part, and then the next, until you end up with a total system breakdown. That's exactly what we're witnessing in the global economy right now. You've got a weakening dollar disrupting global trade flows, which is forcing central banks to move in opposite directions, which is creating currency volatility, which is making trade wars more attractive politically, which is crushing growth forecasts, which is making currencies even more volatile. It's a feedback loop that's honestly just spinning out of control. Look at commodity markets. They're, well, going absolutely insane. Oil prices are swinging wildly, and it's not because of supply and demand fundamentals, but because traders can't figure out which currency to price them in. Gold is acting weird too, because those traditional safe haven flows are getting disrupted. Multinational corporations are getting absolutely crushed by all this volatility. Companies that were profitable just last quarter are losing money this quarter. And it's not because their business fundamentals changed, but because currency swings are destroying their margins. And here's what should really worry everyone. This isn't just affecting financial markets. Real people are losing real jobs because of all this uncertainty. Companies are delaying investments, canceling expansions, and just hoarding cash because, honestly, they have no idea what the economic environment will look like 6 months from now. We're entering what economists call a highly unpredictable environment. That's academic speak for even the experts don't know what comes next. And honestly, when was the last time you heard economists admit they were completely stumped? It doesn't happen often, and when it does, it's usually right before something really bad happens. Let's break down how this chaos is affecting different regions, because the impacts are, well, far from uniform. Europe is in a particularly tough spot. The stronger euro makes their exports less competitive globally, but their central bank can't aggressively cut rates without making the problem worse. Germany, which is basically the economic powerhouse of Europe, is seeing its manufacturing sector contract because German goods are just becoming too expensive for global markets. Asia is being split down the middle. Japan is actually benefiting from higher interest rates attracting capital, but their export-dependent economy is suffering from yen strength. China, on the other hand, is caught between wanting a weaker yuan to boost exports and needing a stronger yuan to maintain confidence in their financial system. Emerging markets are experiencing what economists call sudden stops. These are massive capital outflows followed by sudden capital inflows as investors can't figure out where to put their money. Countries like Brazil and South Africa are seeing their currencies swing 5 to 10% in single days, which is just wild. And even within the United States, the impacts are wildly different. Agricultural states are benefiting from a weaker dollar, making their exports more competitive, but manufacturing states are suffering from supply chain disruptions and input cost volatility. So what does this actually mean for your money, your career, your investments, and your daily life? If you're investing internationally, currency swings this dramatic can either boost or devastate your returns overnight. That European stock fund that was up 15% for the year? Currency movements just gave you an extra 8% boost. But that emerging market fund? The currency headwinds might have wiped out all your gains. If you have variable rate debt, pay attention to what your central bank is doing. If you're in Japan and have a variable rate mortgage, your payments just went up. If you're in Europe and your central bank starts cutting rates aggressively, you might get some relief. Planning major purchases from abroad? Timing just became everything. That European vacation is more expensive for Americans, but cheaper for Europeans coming to the US. If you work for a company with international exposure, these shifts could impact everything from pricing strategies to job security. Export companies are scrambling to adjust prices, import companies are dealing with cost volatility, and multinational corporations are seeing their carefully planned budgets thrown out the window. The key insight? We're not in a normal economic cycle anymore. The old playbooks don't apply. Diversification strategies that worked for decades might not work in this environment. Now, I want to share some insights from leading economists and policymakers who are grappling with these unprecedented conditions. A former Federal Reserve official I spoke with this week told me, off the record, that current policy tools are inadequate for the complexity of the current environment. That's Fed speak for, well, we don't have the tools to fix this. The International Monetary Fund's latest internal assessments, which I've been able to review, suggest that traditional economic models are breaking down. The relationships between interest rates, currencies, and growth that have held for decades are no longer reliable predictors. Recent academic research from Harvard and MIT suggests that we may be entering what they call a regime change, a fundamental shift in how the global economy operates that could last for decades, not just years. This isn't just a cyclical downturn that we can ride out. This appears to be a structural transformation of the global economic order. So, what should you be watching in the coming weeks and months? First, early PMI survey data for the US, Eurozone, UK, Japan, Australia, and India will provide crucial insights into whether business confidence is stabilizing or continuing to deteriorate. Second, watch central bank communications carefully. The divergence in policy is creating communication challenges that could trigger market volatility with a single misplaced word. Third, any developments in trade negotiations, or the lack thereof, will be crucial. Markets are pricing in continued escalation, so any sign of de-escalation could trigger massive reversals. Finally, keep an eye on geopolitical developments. In an environment this fragile, events that normally wouldn't move markets could trigger significant disruptions. This week proved that we're living through one of the most significant economic realignments in decades, possibly since the end of World War II. Dollar weakness, central bank divergence, trade wars escalating to historic levels, and growth forecasts collapsing. These aren't separate stories happening in isolation. They're all connected pieces of a much larger puzzle, and that puzzle is showing us a picture of fundamental change in how the global economy operates. We've seen this kind of systemic transition before, after World War I, after World War II, after the collapse of the Soviet Union. Each time it took years for new systems to stabilize, and the transition periods were marked by exactly the kind of volatility and uncertainty we're seeing now. The difference this time is that we have better tools to understand what's happening, better communication systems to adapt quickly, and hopefully, better wisdom to avoid the worst mistakes of the past. The global economy is at a critical juncture, and understanding these connections isn't just useful for cocktail party conversation. It's essential for navigating what comes next. Whether you're making investment decisions, career choices, or just trying to understand why your grocery bills keep going up, these macroeconomic forces are affecting your daily life in ways both obvious and subtle. The goal isn't to predict the unpredictable. It's to understand the forces at work so you can make informed decisions in an uncertain world. Here in InfoExpress, this has been Global Finance Weekly. and I'll see you next week for another deep dive into the forces shaping our economic future. Until then, stay informed, stay prepared, and remember, in times like these, knowledge isn't just power, it's protection.